Okay, welcome everyone to this year's 2024 Oregon PERS presentation brought to you by Ryan Financial Solutions. I'm your host, Daniel Ryan. We're going to jump right into it. So a couple of housekeeping things. We do have the Q&A or chat as you have questions throughout the presentation. I will address the questions once we are at the end, because I probably will cover a lot of your questions throughout the rest of the presentation. So if I know it's coming up, I'm going to go ahead and wait. If I do see that it's applicable to that moment and we're not going to address it further, then I'll try to add that right in there. My name's Daniel Ryan. I'm an IRS enrolled agent as well as licensed tax consultant. I have a master's degree in personal financial planning, certified financial planner, founder of Ryan Financial Solutions, as well as author of the book, Oregon Public Retirement, which I'll tell you a little bit more about here in a second. You might have already even read that. The reason I bring up these credentials is to not make me sound so important and so smart. It is to give you the quality of advice that you deserve. There are a lot of people on the internet. A lot of them have no credentials, no real profession in tax or finance or what have you. I am an IRS enrolled agent. That's the highest credential that the IRS awards. So I do tax preparation, IRS representation, a lot of tax planning and tax advice. Most financial planners or what have you, they're just simply saying, hey, we can talk to your tax person. Okay, so that's the difference. We actually do it for our client and we take care of everything from start to finish, whether it be their finances, their taxes, and so forth. We also coordinate with an attorney. So that way, any drafting of legal documents, we have all of that taken care of for our clients as well. If you have not looked into my book, Oregon Public Retirement, go on Amazon. It was a #1 new release last year when I published it in 2023. Really excited. It took a couple of years to actually get all of this information compiled and distilled. And of course, it's always ever changing. So we're going to need to update it as well. But the reason I wrote this book is because I come from a family of public servants. I'm extremely passionate about helping teachers, firefighters, librarians, district attorneys, and so forth, because my wife's a teacher, my dad, my brother, my grandfather, my brother-in-law is a firefighter. Everyone in my family seems to be in public service in the state of Oregon. I've been helping public educators and public servants for about a decade now. And I absolutely love working with folks to put all of these puzzle pieces together. And if you're more of a do-it-yourselfer, I wrote a 23-chapter book so that you could do this on your own if you choose to. All the real estate tax strategies, everything that you need about Social Security and how it coordinates with the pension. So go ahead and hit up Amazon and you can get the book there if you'd like to. Also, just a disclaimer before we jump right in here. I am not giving you personalized advice in a webinar. So I'm going to try to answer some questions for sure, but I do not know every last detail about your circumstance. So please do not take this as anything more than educational purposes only. I don't represent PERS. I don't represent Social Security, Medicare, PERS Health Insurance Program, the Oregon Savings Growth Plan, or any of those programs. Those programs do a wonderful job of helping you understand what your options are. And then you talk to a professional and you say, hey, now I understand the program. How does it relate to everything else that I've got going on? And at the end of the webinar, we're actually going to walk you through what I call the retirement timeline, where you start to see all of these things coming together at once. So you can figure out, how much do I need for my 457? What do I do with my IAP? What are my healthcare strategies? What are my tax strategies? Put this all together. If you're one of those people who says, I can do all this, but I just don't want to, or maybe you don't feel like you can do all this, then don't hesitate to go to our website, ryanfinancialsolutions.com, schedule an appointment with myself or one of the members of my team, and we would love to spend a 15-minute phone call just seeing if it's potentially a good fit. We are not hard salespeople. We are professionals. We're here to help. You can see on the website, we actually have a tab that says who we serve so that people know we're focused on Oregon public servants. So go to our website, ryanfinancialsolutions.com, click the schedule appointment button if you're interested in finding out a little bit more. We'd be happy to answer any and all your questions at that point in time. So without further ado, let's dive into it. You can see our agenda. It is action-packed. If you don't know already, I talk fast. I love what I do. I love helping people. We're going to start with the PERS pension programs. And here's the thing. The first myth that I got to debunk is that a lot of people think they are in more than one PERS pension. Now, this webinar is going to be focusing in on general service and police and fire. We are not going to be covering the judge member program. We're not going to be covering the optional retirement plan or ORP, and we're not going to be focusing on FPD&R, which is the City of Portland pension. So we're not going to be focusing in those areas. We're going to be focusing on general service and police and fire in tier 1, tier 2, and OPSERP. Okay, that's today's presentation. So if you are in one of those categories that I just mentioned, you can only be in one of them. A lot of people will assume, because their paycheck might even say you're making contributions to tier 1/tier 2. They say, well, they did that because it's just easier for them to just kind of make a shorthand version of that. But that is not technically what's happening. So let's clear that all up. PERS started in 1946, and until 1996, there was nothing else other than tier 1. So tier 1 folks, you were hired just simply before 1996. Then you have this middle era of about 7 years where folks were hired between 1996 and 2003, August 28th specifically. And those folks are going to be in tier 2. And then, of course, anyone after that, if you've been hired in the last 20 years, you are in OPSERP. So why do I say it like that? I said the word hired very specifically. This is not membership date. This is not anything else other than the first time that you were hired by your very first PERS employer. There's some qualifications, being in a qualifying position, for example, how many hours you worked and so on. Did you have loss of membership? I get it. There's always exceptions. You might remember your hire date. You might not. If you are 30 years later and you're trying to remember, hey, I don't remember if it was, August 28th or August 27th or what have you. Well, that's fine. Go to your PERS statement and that will tell you. You can also log in on PERS and go to PERS member services, and then that will certainly clarify that as well. But before we get into all these different details about how the pension's calculated, really important that you know which of those three do you fall into. And then for police and fire, we'll talk about some exceptions in your retirement side. But you have to know, where am I? Tier 1, tier 2, or OPSERP? That's just what everyone needs to know. And it's always based on the hire date. Now, the thing that you can have in conjunction with your pension, which is the stream of income for life, by the way, you have now your IAP, or individual account program. And you might also now have what's called your EPSA, Employee Pension Sustainability Account. If you stopped working before 2020, then you didn't have to worry about the EPSA. Now, the IAP is in the center of your statement. Okay, it's in the middle. And the reason that it exists is it used to be, before 2004, folks would make 6% contributions to their pension itself, and you didn't have anything else other than a stream of income for life. Well, then in 2004, PERS said, hey, we are giving guaranteed rates of return and getting some pretty crazy outcomes that don't really stand the test of time, financially speaking and mathematically speaking. We need to push some of the risk off of PERS and put that back to the member, and also give the member some flexibility with a lump sum version of their pension as well. Well, okay, there's some good and bad there, I think. Now, the first thing is that 6% contribution that you were making, or perhaps your employer's making, called the PERS pickup, that is in fact going from your paycheck to your IAP. Now, we'll talk about the IAP redirect here in a second. But the point is that there's no guaranteed rate of return. You have this immediately vested amount. We'll talk about what vesting is in a second, but it's your money, okay? And also in 2018, PERS decided, you know what, we're going to make sure that you can change your investment from a general fund to actually based on your age. And then in 2020, they allowed us to actually change which target date fund you can invest your IAP. So I'll give you some pointers on that here in a minute. The last thing is that I consider the IAP, quote, a glorified 401k, just to simplify. Now, what about this IAP redirect? I get a lot of questions about this. Senate Bill 1049 passed in 2019, became active in 2020, and it changed quite a few things. It's a pretty drastic change for PERS, actually. And so for the last 4 years or so, we've been working with the new rules, and that's working in retirement rules, the IAP redirect, and a few others. But the IAP redirect says, hey, if you made $100,000 and you're used to putting $6,000 into your IAP, if you're tier 1 or tier 2, we are running a little low on the ability to pay your pension part of this deal. So we need to redirect. some of those contributions. So instead of $6,000 making it into your IAP, magically $2,500 or 2.5% didn't quite get there. It went into this other employee pension sustainability account. And that is something that you see now on the bottom of your statement. That's not really your money. If your path is to go and say, hey, I'm going to take the monthly pension, you forfeit the EPSA. Okay. If you said, hey, I would like to cash out everything, well, then you can actually get access to your EPSA. So that's the only reason that it's still on your statement. It is still sort of your money, but not also really your money. Now, that being said, it's a 6% contribution to your IAP. Almost half of that contribution for tier 1, tier 2 folks didn't make it to your IAP going forward. The theory here is that tier 1 or tier 2 people, you're almost out probably. If you were hired in 1995, you're probably retiring in like a year or 2 years from now. If you were hired in 2003, you're going to be retired in less than a decade. For OpCert folks, you might be paying into this EPSA for all 30 years, right? So think about why it's a smaller percentage is because they're trying to recoup everything for tier 1, tier 2 people before you leave. For OpCert people, this is going to be just a new part of your pension, probably forever. There's a $28 billion unfunded actuarial liability, which means debt. And we got to figure out how to do with that. So PERS came up with this. PERS is really just the administration. Technically, the state is actually who passes all of this legislation. Now, the last thing I want to say, though, is that if you have less than just over about $30,000 a year of income, usually when I'm talking to a school district, this would be your classified staff. And then you got certified staff, which are your teachers. The teachers are usually having this IAP redirect issue. The classified staff maybe not. And that's because it only is for folks who are making more than about 30 to 35,000. It adjusts with inflation each year. That being said, the last part I want to make about this is that they're allowing you to make what's called a voluntary contribution back into your IAP. So this gray arrow that you see says, hey, the yellow arrow took the money away. The gray arrow is allowing you to put it back. Now, here's the question. Would that be a good idea or not? And I would say 99 out of 100, probably not a good idea. The reason is when you make your 6% contribution, that is a tax deduction on your paycheck. When you make a voluntary contribution, that is what's called a non-deductible contribution. Don't confuse non-deductible with a Roth. Okay, it's not. A Roth means that you contributed to something and it grew tax-free. A non-deductible means no deduction, and whatever the growth came from that is still fully taxable. So there's something called basis in your IAP, and that's really important when you try to do a rollover. So that's one part that I want to make sure everyone understands. If you are doing voluntary contributions, you might want to consider stopping that. Again, if you make $100,000 a year and you're going to contribute $2,500 to your IAP, it's an all or nothing deal, by the way, to make that voluntary contribution. If I was going to do $2,500 contributions, I would probably look at doing a Roth 403B or a Roth 457 contribution because the money growing from that contribution is tax-free. So if you're going to make a different, try to fill the gap here, it's a noble cause that they're trying to allow you to put more money into the IAP, but I really doubt that that is going to work for anybody. It has never worked for any of my clients. As soon as I see that someone's doing that, I will tell them, please stop doing that. Here's a better way. Roth 403B, Roth 457, and so forth. So the last part I wanted to say about the IAP redirect, they are not taking money out of your IAP. They are taking money out of your contributions going forward. A lot of people thought that if they had 200 grand in their IAP, that they were going to start coming for that nest egg. They said, no. What you've already got in there is fine. It's future contributions. Okay. Now you get to the end of your career and you sign for the paperwork with PERS pension, and you decide what distribution option should I choose for my IAP. You have a lot of considerations when you do your retirement application. I work with a few hundred Oregon public servants. I talk to hundreds each year, either teaching or just education, doing events and so forth. And so one of their questions is, well, what am I supposed to do with this IAP? Well, the lump sum distribution has two different meanings. It means that you could either get it in your personal name or you can do what's called a direct rollover. And that's usually where you want to fall into that camp. A direct rollover means that on the PERS application, you actually put the custodian's name for the benefit of, or FBO, your name. So that's why I like to make sure that folks know, please don't put your own personal name. You will get 20% withholdings, 8% taxes from the state of Oregon, and that's about a third. Okay. Almost a third of your IAP just doesn't make it home. Then if you did a direct rollover, we don't have to do any tax withholdings. We get to move the whole amount. And then you get the flexibility of investments. You get the flexibility of distributions as you need the money. You will only be then taxed on the amount you distribute as you need it. The other thing you might consider that is still rollover eligible is what's called the 5-year installment distribution. That means that if you had $120,000 IAP and you wanted monthly distributions for 5 years, they would give you $2,000 per month until it exhausts the account. And usually the only reason that I would see someone do that is if they retired at 58. If you're a tier 1 member, 58 is a pretty critical age because that's what's called your normal retirement age. If that be a good strategy for you, you can still roll it over once you get to a different part of that 5 years. So you might start at 58, start taking that $2,000 a month. And then when you hit 59 and a half, where there's no penalties to distribute from IRAs, then you might move it over to an IRA, and you're allowed to do that. Now, certainly those of you working with a tax professional who does your financial planning, we recommend Rule 72T, where we actually set up a separate IRA account. This avoids penalties by setting up substantially equal periodic payments. We file all that paperwork for our clients. So that's how you can get around this idea of keeping this IAP with PERS. Knowing Rule 72T, there's really not a good reason in my book to keep the money at PERS unless you really want such a hands-off experience that you just say, hey, please just send me the installments as if it was a part of my pension. But the problem is you have no flexibility in your distribution. So if you suddenly have a big medical event or a big desire to change your spending, PERS is going to say, hey, you signed the paperwork. If you chose the 10, 15, 20-year options or anticipated lifespan, you are set in. So get along for the ride. You can't change it. If you need more or less money, or if you have a tax strategy, you want to do a Roth conversion that year, there's no flexibility. So that's why I say almost everyone will say, hey, for the tax flexibility, for the distribution flexibility, for the investment flexibility, I'm going to go ahead and move that money into an IRA, and then we're going to figure out what to do with it from there. Okay. Now let's talk about membership investing. These are fancy words maybe, but membership means that you are in a qualifying position. You are in fact a PERS member. Usually everyone knows if they're in a qualifying position. If you're here, you know that you're in a qualifying position. So I'm not going to belabor this, but usually people get confused if they're a volunteer at a school district. Just because you're a part of the PTA, that's not a qualifying position. You have to be employed by a PERS employer, and the intent has to be more than just a temporary position. A temporary position might just be for 90 days. You might not get to the requirement of 600 hours. It's very unlikely, in fact, that you would get to these 600 hours in that 3-month period of time. The other component too is wait time. So in your PERS membership, you might have been a school teacher. You might have gotten hired in August, but you became a PERS member in March of the next year. You can even buy back your wait time if you're tier 1 or tier 2, but you haven't started paying into the PERS pension system. You haven't paid into your IAP yet. This wait time is essentially like a probation period so that everyone knows that you're going to stick around. Once you actually do hit that 6 to 8 month wait time, which is where you get 6 months with 50 hours a month in there. Teachers usually have closer to 8 months because you might have gotten hired in August or July. So thus you got typically 8 months of wait time. IAP contributions will then begin, and you can start making that 6% contribution. Or if your employer does that, they would start the contributions at that point as well. So that's what membership is. On your PERS statement, it'll say your hire date, and then it'll say membership date to the right of that. Vesting is a little bit different. Vesting is a fancy word that says you're entitled to some benefit, some of it. We don't know how much yet, but you're entitled to something. Okay, so you have to have 5 years of service, 5 calendar years. For a school teacher, that usually falls into 4 school years because you're hired about that halfway mark, basically September to June of the next year. So you have to have 600 hours in 5 different calendar years. Once you meet that requirement, you will then be fully vested, which means that if you leave for whatever reason, you can come back later. and you are still going to be able to pick up right where you left. And that is a very, very important thing. For those of you who are listening and you are early in your career, please become vested. I have had a client where they were in California for 4 years, Washington for 4 years, and Oregon, and they are just about to vest in the very first pension. They have been teaching for almost 15 years, but they have not vested in all these pensions, and they've moved around quite a bit. When I explained that to them, they suddenly became very interested in how that works. You also have something called your retirement age. Now that becomes automatically vested. So for example, if you had taught forever in California and then you just moved up here to Oregon to start teaching, then your normal retirement age for an OPSERP member is age 65. We'll talk about that here in a second. Now, if you started at age 62, then you will automatically become vested at 65. Okay, you didn't have to do 5 years. So they give you that one, grace opportunity there. Your pension is going to be very, very small if you decided to retire with 3 years or 4 years of service. So just know that, but you will be entitled to something, which is nice. Now, membership loss, this is why I bring this up. This is what happens if there's more than 5 years from the last time you were working for a PERS employer. Let me give you an example. If someone worked for 4 years, 4 calendar years, and then they left for 5 or 6 years because of family reasons, wanted to be with the kids or wanted to try starting a new business, didn't work out, so they came back. Maybe they worked in a different state and then they came back, but it's been more than 5 years and they didn't vest yet. You have what's called loss of membership status. That means you got to start all over. So some of my clients will have a tier 1 or tier 2 loss of membership status. And if you came back, let's use the example, you got hired in 1993, which is tier 1. You did 4 years and you left in 1997. You came back in 2002, and that's more than 5 years, just over more than 5 years. Then you came back as a tier 2 member, and your tier 1 account went into loss of membership status. As a tier 2 person, you can buy back into tier 1 status if that be smart and wise. We'll talk about some of those implications here in a minute. If you came back as OPSERP because you came back after August 28th of 2003, you cannot buy back into tier 1 status or tier 2 status. So that's why I like to make sure that folks understand if you do leave, it goes into what's called loss of membership. If that be the statement that you get each year, it basically says you can't do anything with this until you have 30 or more days after you actually quit or retire. Then you can do something with that account balance. It is still being invested for you, but there's just an account balance of your contributions that you made to the pension, and you are entitled to those once you stop working for your PERS employer. So once you're vested, man, you're good. Okay, so that's really critical, really important that we understand the differences there. Now, I wanted to give you a quick example of how this all comes together. Now, what if you're a school teacher, for example, and you had that 6 to 8 months of wait time, but you were hired in August 1st of 2003, but you became a PERS member in March 1st of 2004. So you guys remember the timeline differences. Well, hey, which pension is this person in? Well, it's tier 2. And the reason is because tier 2 is based on hire date. All of them are based on hire date. And so since the August 1st timeline falls before the August 28th of 2003, that would be a tier 2 person, even though membership started in 2004. So that's how this looks. On the bottom, you can see that wait time was 8 months. Your service credit is now about 4.5 years. And then your total service credit is 5 years, 2 months. The reason total service credit is important is that, first of all, that tells me that you are vested. So that's helpful to know. It also tells me that because you're tier 2, you can buy back that 8-month wait time. So that's really critical. If they had been hired just a month later, then none of that would have been able to be purchased back, and we would have less opportunities in retirement. Okay. So let's talk about, well, when can I retire? Okay. So tier 1 members, if you hit 30 years, same with tier 2 members for that matter, and you're in general service, 30 years, that's what gets you there. Okay. Awesome. Easy. So if you got hired at 22 or 18 or whatever it is, hey, 30 years, we're good. Okay. Keep going and you'll be fine. Now, if you didn't get to 30 years, usually because you started later in your career or you were working in a different state, different job, what have you, then they're going to say, hey, if you get to age 58, then you can go ahead and work all the way up to age 58, and then you can have an unreduced pension if you retire at age 58. For tier 2 folks, that's going to be age 60. So slight difference. Okay, so that's how that works. Let's say that you got hired at 22. You had a big gap in service because you went to start your own business for 10 years. Okay, but you were vested, and then you came back and kept going, and you say, boy, I only got like 20 to 25 years, but I'm 58. You might be looking at that as a good, viable option to retire. And as we'll talk about with calculations, you might still benefit on delaying the pension or claiming the pension. Depends on if you're on money match or full formula. Then you have the OPSERP folks. My wife and my brother are in OPSERP, okay, Oregon Public Service Retirement Plan, OPSERP for short. The deal with this one is you have to be at least also age 58. My wife started at 22. She cannot retire with the full pension at 52 because she's an OPSERP. But my father, who was in tier 1, he could, okay? So how that works is my wife could either keep teaching and get to 36 years of credit and be retired at 58, or take a break and say, hey, I'm going to come back to teaching or some other PERS role and retire at 58. Doesn't matter. Any combination is fine. If you had a big enough break and you said, hey, I'm coming back, but I'm not going to be at 30 years at age 58, then it becomes a normal retirement age of 65. So let's say you have 20 years of service because you started at 45 and you hit age 65. You're like, I'm just done. I don't want to do this anymore. That's okay. You can actually retire with an unreduced pension at age 65. Okay. If you're police and fire, same concepts, just slightly different ages. That's the only difference you really need to take away from this. Instead of being 30 years, it's 25 years. And you also have to be at least age 50. So if you started at 22, okay, that's where you actually have to go all the way and retire from the fire department or police bureau. Okay, you can't just let it go, come back later, okay, and do something on the side. So you do need to retire from the pension under a fire and police role. Also, with the new legislation that came out in 2023, deputy district attorneys, just the deputy ones, okay, deputy district attorneys are now calculated under police and fire pension rules. So if you didn't get to 25 years and you're over age 50, you got to basically wait till age 55 if you don't have 25 years. Okay, you got 20 years. At 55, they will let you go and you can retire with an unreduced pension. Then if you have tier 2, it's exactly the same as tier 1. For those of you who are OPSERP, same concept I brought up with OPSERP before. They finally figured out people are living a lot longer than we thought. My grandfather was a retired PERS member. He was retired for about 40 years. Oof, that's a lot of PERS payments. Okay. So that's a lot more than he worked or paid into the pension system. So thus they are telling you as a firefighter, police officer, you have to be at least at age 53 and have 25 years. Or if you don't have 25 years, age 60. Now, I want to bring up the earliest possible retirement to demonstrate how discounted or penalization occurs from a reduced pension benefit. So if you are an OPSERP tier 1 or tier 2, it doesn't matter. Everyone can technically retire as soon as age 55. That's when you can get the pension. You know, let's pretend for a second that you just leave. Okay, you're age 50 or 40 and you're just like, I just don't want to do public service anymore. I've been doing this for 20 years or whatever it is, and I just want to go. Can I get to my pension? No. You haven't met the requirements of being at least age 55. You can't even touch it. Okay. You can't get to the IAP separately. Okay. There's very strict rules here. IAP minimum age 55 as well. If you're going to retire without the full pension, in this example, an early retirement. So that being said, if you're general service, then you cannot get to the pension until age 55. If you had prior 5 years and you were actually in police and fire, you could get to it at age 50. That would be the soonest. So what that would look like is I have 20 years of service as a police officer. I am now age 50. So I worked from age 30 till 50. I can technically get to my pension, even though I didn't hit 25 years yet, but it is going to be severely reduced. If you have a normal retirement age of 58 for general service tier 1 and 60 for a general service tier 2 and 65 for OPSERP members, and you just stopped working, you can get to everything. You can get it all at age 55, but it will be reduced based on how far away you are from your actual retirement age. For the OPSERP members, that is a 10-year gap. and it's about a 7% reduction each year. So that means about 2/3 of your pension would be reduced. If it was going to be $3,000 a month, you're going to get $1,000 a month if you take it 10 years early. Ouch. Okay, probably not worth it at that point. At that point, you might just say, I will come back and I will just not work in the public sector. I am glorified unemployed from the public sector. I might go do my own thing, and I will retire under PERS at age 65 if I have, in OPSERP at that point. And the same concept for tier one, since there's a 3-year gap, it's about a 20% reduction. So you can do the math for every one of those circumstances as to what your pension should have been, how much it'll be reduced. Your PERS estimate will run that calculation for you. Okay. But this is how that works. It's a 7-year reduction every year that you are away from your normal retirement age. If you were 55 and you're tier two, that's 5 years. 5 times 7 is 35, 35%. So about a third. Okay. So how do we even calculate the pension at all? Right. Well, great question. The first thing we got to know is that there are technically 3 different calculations occurring if you are in tier one. So tier one folks that were hired before 1982, you are probably in something called formula plus annuity. That is over 40 years ago. So there are just a couple of you, just a handful that fall into this category. If you'd like to know how to calculate your pension, give me a call. I'd be happy to walk you through that. But there are less than 2% of PERS members that will fall into that category. As you can see, it takes into account your years of service, your average salary, your age, and your account balance. There are a lot of moving pieces going on there. For those of you who are tier one folks, most of my tier one clients are still retiring under money match because they were usually hired in the late 80s or early 90s. Those of you who are tier one and you're still 1995 and beyond, you're probably in what's called full formula. And if you're in tier two or OPSERP, 95% chance. Okay, for OPSERP folks, it's 100% chance you're in full formula, which only takes into account your years of service and your final average salary. Has nothing to do with your age, nothing to do with your account balance, because you don't have an account balance as an OPSERP person. But if you're in money match, it's because you're a tier one person that actually fell into these, late 80s, early 1990s hire date, and you've been working at all those first, 15, 20 years of your career. So what does all that mean? Okay. Full formula, I'm talking to tier one, tier two. You are a different calculation than OPSERP folks, just ever so slightly. Tier one and tier two, you have 3 different factors: your years of service, your final average salary, and a factor of 1.67%. For OPSERP people, the only difference is that you have a 1.5% factor, so just a little bit less. Now, I like to make life simple whenever possible. So if you are, in fact, in full formula, then you can take 30 years of service and multiply it by your factor. Well, 1.67% times 30 is 50.1%. So about half of your final average salary is going to be replaced by the time that you get to your pension. That assumes an option 1 benefit, which we'll talk about here in a second. And it doesn't take into account your tax remedy if that be applicable for your tier 1 folks. But that's how it works. For OPSERP folks, it's 30 times 1.5. That's 45% of your final average salary. So we just made the PERS pension pretty simple, didn't we? If you're in full formula, which over 90% of PERS members are today, then you could pretty well say it's either 45% if I'm in OPSERP or 50% if I'm in tier 1 or tier 2. Pretty cool. Now, what if you are in fact in that tier 1 category that has this money match calculation? It takes your account balance, your age, which is actually an actuarial equivalency factor. And then they say, okay, we're going to multiply that by 2, and that will get you your monthly benefit. Now, the reason that that's critical, union contract benefits. If you have a union contract, you need to know, am I money match or full formula? Because they give me different benefits based on that. Sick time goes into full formula for most employers, but it doesn't go into money match. They might pay you out sick time if you know how to request it. So that's why you got to figure out, well, which one of these am I actually in? Okay. If you're police and fire, ever so slight change to those same numbers. So if you're going for the 25-year timeline, it's the same net result. 2% for tier 1, tier 2 folks times 25. Hey, that's 50%. So we still got to the same net result. It's just that general service had to do an extra 5 years to get there, right? 30 years, 1.67. Okay, same thing for your OPSERP folks. You're going to get to that same 45%. You're trying to get there as well, but you're going to get there in 25 years. Okay, so that's how that works. And then money match for police and fire, same thing. Account balance, as well as your age, and you're multiplying it by 2. Okay, so that's how this works. That's how we calculate it. But like I said, these words like creditable years of service, well, what do you mean by that? Would that include purchases or not? What about final average salary? What does that really mean? So let's dive into those two components a little bit more here. Your final average salary is going to be taking either your last 36 months or your highest 3 years. Now, for tier one and tier two folks, those years do not need to be consecutive. You might have 2 years where you were a school administrator randomly in the middle of your career, and then you went back to being a teacher or you took time off. And then you said, okay, well, I'm going to come back and I'm going to do some summer school and extracurriculars, right? So your years don't have to be consecutive as a tier one or tier two person. So if you have that in your history where you're like, well, I make 90,000 now, but I made 150, 10 years ago, which number will they use? Probably that 150 from 2 years ago, and then your most recent salary at 100,000 when you retire, and then they will average that out by dividing it by 36 months. That becomes your final average salary. For those of you who are in OPSERP, they do need to be 3 consecutive and also calendar years. Everyone, it has to be a calendar year. So for school teachers, that can get a little wonky because you might have been a school administrator for 2 school years, but it actually only fell into 1 full calendar year, and then half and half into 2 other calendar years. So we gotta look at that and see. But PERS is going to run the math for you. You don't need to worry about it. We just need to look at your history so that we can appropriately plan for it. Because my whole concept here, as you'll see at the end, is that if we don't know where we're going, how do we know how much we need to save? If someone hasn't looked at your work history to see that you have 2 or 3 years over here from a decade ago, that is actually what the PERS pension will be based on. Well, then you might be saving too much in your retirement and not putting enough towards your mortgage, not putting enough towards your kids' college or whatever else you might have as a goal. So that's why it's really critical that we look at this and we know where we're headed. Now, that's how the final average salary works. There are a couple of exceptions to that, of course. Your final average salary also pays in from vacation time. So police and fire, maybe you work for the city. All of you folks that are in tier one, we get to put your vacation time towards that. And we also get to put your sick time if you're tier one or tier two. Both of you get to put sick time. You get half credit. So the way that that works is if I had 98,000, 100,000, and 102,000, those are 3 years that PERS will look at the numbers and say, okay, your average is 100 grand, but you had a year's worth of sick time saved up. We'll give you $50,000 as a calculation point to say instead of 300,000 divided by 36 months, we will do $350,000 divided by 36 months. That's essentially how that works. It's going to be based on your hourly rate that you're making now for your final average salary, and that's how your sick time gets paid out at half price. So I like to make a point of that so that everyone knows, hey, I maybe don't want to use up all this sick time, so that we can actually enjoy a higher level in retirement. I usually see a pretty considerable increase, by the way, for those of you who are wondering, hey, how do I really work this to the system? For those of you who are police officers, firefighters, you can take extra shifts to make your final average salary really stick out those last couple of years. Some people will save all their sick time for this reason as well. It could save you several $100s a month, which is several thousand over the course of each year of retirement. So really big deal if you know how that works. A cost of living adjustment with PERS, but it's been reduced over the years. In 2014, there was actually a reduction to 1.5% for any years of creditable service that you have from that point going forward. So I'd like to give an example. If you were a tier one person, you knew 2%. Hey, that's going to be the cost of living adjustment, which means that I will get a little bit more from my PERS pension each year. If I was getting $50,000 a year from my PERS pension, I would get $51,000 the next year. And then it will go up a little bit more than $1,000 each year after that based on inflation. But it maxes out at 2% for those of you who had creditable years of service before 2014. Those of you going forward, you have 1.25%. So the way that that works is if you were hired in 1994 and you're retiring this year in 2024, you have 20 years from 1994 to 2014. That would be used as your ballpark for 2%. And then you have 10 years at 1.25%, which effectively makes it a blended COLA of 1.75%. So that's the point. It's going to be somewhere between 1.25 and 2%. It will not be any more than 2%. but that is the way that PERS actually runs their cost of living. And they use the West Coast CPI. But I'll tell you right now, especially in the environment that we are facing with inflation in the last few years, it's going to be maxed out pretty much every year of your retirement. There hasn't been a period of time where we've been less than 2% for a long, long time. So let's talk about written estimates. As we get to the second half and start to wrap up and put all this together, Daniel, I have a little bit of a foundation now as to how the PERS pension works, but where do I go to actually get the information and start to work with it appropriately? Well, if you want a written estimate, you have to be within 2 years. You got to be within striking distance, basically, of your retirement date. Now, that does not mean that if you want to retire at age 60, you don't have to wait till you're age 58 to do your first one. You have to be age 53. That's the soonest that you can actually get to an early retirement pension statement. And that's, like I said before, age 55, everyone can actually apply for that. Police and fire, age 50, so 48. It would be the soonest that you can apply for that. Now, why would you want to do a written estimate when you're several years? Just to get some basic numbers would be really helpful. For example, we might find out, hey, looks like you had 2 or 3 really good years being used in your final average salary from about a decade ago. That will show up as reported on that second page of the estimate and tell me which salaries showed up there. If I don't see any outliers, then I know that, hey, going forward, these are the salaries we need to make count. It will also tell me how much sick time do we have saved up. Okay. It will also tell me what's the purchase cost of wait time, maybe forfeited time, maybe other different purchases like out-of-state teaching or out-of-state police service, whatever it may be. So we want to still do a written estimate as often as we can just to get that extra information. We might also find, hey, you don't have the right reporting here. You said you had 25 years of service. I'm seeing now that they're only showing 23. Where is that being misreported? Then we might need to go into the path of account reconciliation, data verification. We might need to go through that process because we can start to see that there's some missing links here. You will send the form via mail or fax. It's just a one-page form. You put your information, you put your beneficiary if you're going to have one, and you put all that information so that person can get that to you. Right now, they're about a 1 to 3 month return time. So they'll mail that to you. You can request a fax copy if you like, but that's how it works. And then, of course, they will provide what's called a purchase letter. Now, if you are in fact within 2 years of retirement, you definitely want to have this. If you're tier 1, tier 2, you got to have your written estimate. That's because they attach the purchase letter for your wait time no matter what. Okay, if you have wait time, which you do, they're going to send you the purchase letter and you have to attach that to your PERS application. And then you have to decide, am I going to buy that wait time with my 457, my 403B, or my bank account? Those are your only options. So then you got to look at that and fill out some other paperwork if you want to do your 457 or 403B. Okay. So that's how important the written estimate is. Now, what if you say, well, I'm 25, I'm 35. Okay. I'm nowhere near retirement yet. What is the better option? Online member services, OMS. Do an online estimate. You can do an infinite amount. Written estimates, you get 2 free ones per year. Online estimates, you can do infinity. You just keep running different numbers. Now, the biggest concern I have with this is that people put in the wrong numbers. They look at their final average salary and say, hey, that's my PERS pension. I say, no. So you got to make sure that you know what you're putting in, because good numbers in, good numbers out. Bad numbers in, bad numbers out. Okay. So a lot of the times I see the issue with the member services online estimates is user error. So you might be the exception to that rule, but a lot of folks are not sure what they mean by certain questions. And so they just input the wrong information. Okay. But please set up an online member services account. You can see your work history. Your employers are listed by school district or what have you, city and so forth. You can get instant results, and it will certainly give you a pretty close estimate. Then it spits out basically what we're looking at here, which is this table. This is an example of a written estimate, and it's going to have all these different options for a tier 1 or tier 2 person. Now, I'm going to talk about the OPSERP pension here in a second for your distribution options. But for tier 1 and tier 2 folks, if you look at this and you add the with purchase options, there are 26 combinations. So you got to know, what is option 1, refund annuity, option 15C, option 2, 2A, lump sum combinations, total lump sums. My goodness, there's a lot going on here. So we're going to dive through this, but you can see right off the bat, as I talk about this, most frequently, the ones that people will choose are option 1, which is all about number 1, which is you. Okay. It's going to be the highest pension payout out of all of them in the monthly status. And most people will then choose an option 2 or 2A. Those are the three most common. I do see some 15Cs with my clients, and I'll show you here how that works, but very rarely do the lump sum combinations work, and very rarely does the total lump sum work. If you're an OPSERP member and you're saying, boy, I wish people would spend more time talking about OPSERP. If I was just talking to OPSERP folks, you have a calculation that is very simple in that you have no purchase options. You have to retire with 30 years and be at least age 58 or age 65. And your formula is your years of service times 1.5%. That'll get you to 45% if you're at 30 years. Now, the single life option, as you can see, I've put the one thing that does apply to OPSERP members on this page as the single life option. That's the language that PERS uses for OPSERP people. So if you're an OPSERP or tier 1, tier 2, you all have this benefit as option 1 or single life, same thing. Okay, what it means is it's going to be the highest benefit amount, but if you pass away, the money's gone. So a year into retirement, you got hit by a bus, there's nothing left. If you got a spouse, they're not going to get anything. It is, in fact, the biggest and highest benefit. But if you're not single, you got kids, dependents, spouse, partner, something like that, you might want to consider some of these other options. Okay. That one's the easiest, in my opinion. Then we have for tier 1 and tier 2 only, 15C. That's 15 years certain. And what it means is I can put multiple beneficiaries and not have their age affect the benefit amount. So for people who say, well, I'm retiring at 50 because I'm a police officer, firefighter, for example, that's pretty common. I'm 52 and I'm a school teacher. I have a lot of clients who retire in their early 50s. Okay, that's very normal for public service. So how do we do this? We look and we say, I got kids in college, right? I need to have my spouse be able to be okay until they can hit Social Security because I'm still a decade plus away from all these other components. I'm still a decade away from getting to Medicare. So your first 15 years, you might even have a mortgage still. I'm still 15 years from getting my mortgage paid off. That first 15 years in your retirement plan is absolutely critical. So if you want to make sure that everyone in your family, your kids and your spouse are going to be okay, you could put your spouse as a primary beneficiary and put your kids as a contingent beneficiary. And then what happens is if you're used to getting $5,000 a month from 15 years certain and you passed away 5 years into retirement, then they will still get the remaining 10 years. That is the deal with PERS, is they're giving you for certain 15 years. Now, what happens if you don't die and everything's awesome? That's okay. The money keeps coming. It's just that if you passed away after 16 years, it's just like option 1. It's gone. So I just like to make sure that people know that. You can even put a church or charity or some kind of organization. It doesn't have to be a person. That refund annuity is the next one. A pretty similar concept, but it's not a stream of income for life. It's your account balance. Now, there are people who I've seen had 7 figures, $1 million accounts with PERS, but that was 20 years ago. Okay, that's not what we're looking at in most circumstances today. So for most of you who are going into retirement, the refund annuity is not going to work because you're going to dry that account balance out and then you're going to keep taking payments for life, which is fine. But when you pass away, just like option 1, you don't get anything. The lump sum is basically saying, hey, what if I want to do a self-directed IRA and buy real estate? Or I have this advisor and they want me to take out my entire pension so that they can get paid on it and take a commission and run away. That is something I would be very, very cautious about. If you are getting that advice, the only circumstance that I have seen that made sense is that you actually have someone with a terminal illness and they know that they will not be getting the money that they need from the pension and they have no other survivors that they need to support going forward. If that be the case, maybe the cash out circumstance makes sense. The reason that the self-directed IRA doesn't make sense, especially if you're going to do real estate, is because you do not have the ability to keep pace with PERS's guarantees. PERS is going to be paying out something closer to 10 or 12% rate of distribution withdrawal in comparison to what a safe withdrawal rate would be for somebody closer to 4 to 6%. So you're not going to be able to sustain the income and certainly the risk that's involved with that. If you go the real estate path, you have things that are called unrelated business income tax, UBIT. There's a lot of things that you don't know. There's self-dealing rules and you can't work on the property. There's a lot of things that people don't know about running a self-directed IRA. So I just like to make that a point if that be your goal. The lump sum combination, now this could work. Okay, lump sum combination says, if I go back here for a second, what if I want to choose the with purchase option 1, and I want to get $200,000 or $100,000, whatever is in my account balance. I want to get that up front because that's where I can pay off my mortgage, or I can take all those trips while I'm in my good health. And my spouse has a pension that's coming, but it's later. So I don't need the money then. I need it now. Well, that could work. And that can be a fine strategy to do the cash out combination option. Okay. But again, you got to be really wise. You got to really know where your income sources are coming from. Hence the retirement timeline I'll show you at the very end. Now, these are the least, the 3 and 3A are the least chosen options. Okay. 2 and 2A are probably the most common for a spouse. Okay. So full survivor option, that's what they call it for tier 2, tier 1, they call it option 2 for tier 1 and tier 2. They call it the full survivor for OPSRP folks. Okay. So OPSRP, you can see that you have pretty much all the same options here for survivors. You didn't have the lump sum combination options. You didn't have refund annuity or 15C, but that's okay. Most people choose option 2 and 3. Okay. These 4 options that you see here. So how do these work? Well, if you have a spouse, you probably want option 2 if you want to keep life simple. That means that if I'm going to get $5,000 a month and I pass away, I will get $5,000 a month to my spouse until they pass away, and then the money's gone. It does not need to be a spouse, though. It can be a partner. It could technically be your child. If you have one child, that would be maybe okay. If you have 2 kids, you can only put one person. So you are definitely playing favorites. It is also, in fact, based on the age of the beneficiary. So this is why you do not want to put your children on your option 2 or any one of these survivor options. And that's simply because they're going to look at, well, if you passed away in year 1 and your kid is 30, we might be paying this pension out for the next 50 years or something like that. So they are going to err on the side of, well, we're going to give you a really, really small pension then. It's not going to be $5,000. It's going to be $2,000. So you got to look at those numbers and say, does that really make sense? But it is, in fact, a 100% full replacement of that benefit. Option 2A is really good for folks who have maybe a spouse that they wanted to put on there, but their spouse is older. Maybe they're in worse health than that person. Option 2A allows the PERS member to go back up to the option 1 benefit. If their beneficiary passes away or they get divorced, they can go back up to option 1. Okay, so that's how that one works. The half survivor option is for those people who maybe have another pension coming on the way that is going to be more favorable to their surviving spouse. Okay, so 3A gives you a better benefit up on the front end, but it only gives you half price if you did pass away. So you had $5,000 coming in, you passed away, you only get $2,500 going to your spouse. So that's how that works. Option 3A gives you that survivor half increase option. So that means that if, again, as a PERS member, your beneficiary or your survivor beneficiary passes away or divorces, you get to go back up to option 1. There are 16 purchases. I could do an entire webinar just on which purchases to look at and what you even have available to you. For most people, wait time is the only purchase you will have. That is only available to tier 1 and tier 2 folks. That's why there's no yellow there. Okay. But you do not have this ability to just buy any of the purchases. There's 16, but most of them will not apply to you. If you do have out-of-state service, either as a teacher, firefighter, police officer, whatever it is, and you said, well, I didn't get any vesting into that pension. I only did 3 or 4 years. You can actually buy that time. Now, the calculation is going to depend on your hire date, your age, and we got some other factors here because they will actually be a full-on calculation as to the present value of that dollar amount. Does it make sense to use my 457 to purchase out-of-state service? Maybe, I don't know, but PERS will need to put that into their written estimate to really work out the details for you. Okay, we're on the home stretch, folks. So now we're going to talk about, well, how do I put this all together? One of the most common things people will do is actually work in retirement. Sometimes we call it working the bubble or double dipping. This is especially popular for school teachers, where you will start the school year in that final year that you're going to retire, and then you will retire so you can collect your PERS pension maybe as soon as November, typically. And then you will finish out the school year collecting your full salary and your pension. And I call that the turbocharged retirement. We're getting both and I like that deal. What if I told you that all of a sudden you're going to get an extra $3,000 or $4,000 or $5,000 or $10,000 a month based on your pension coming in while you're also getting your normal salary? That's a pretty cool deal. We got some tax implications we got to be worried about. Probably want to put some money away in your 403B or 457. But that being said, it's a pretty great strategy. For most people, you have to know what your district or your employer is going to say about this. This is really specific to them. After Senate Bill 1049 and then even a renewal of the working and retirement rules that came about recently, you can work an unlimited amount of hours. It used to be that you had the 1040 rule and you can only work 1,039 hours for a PERS employer with your pension without having to come back into active member status. The issue that you want to be aware of is, does your employer work with this ruling? So PERS is okay with it. Is your employer okay with it? The other thing I like to point out is that people think, well, hey, I can just go work and collect my pension no matter what. Well, there's one quick caveat to that. It's only if you have an unreduced pension. So for example, this is for tier one people. If you were hired before 1996 and you said, hey, I have 30 years of service or I'm over age 58, well, then you don't have any hour limitations. But what if you didn't hit 30 years and you are between age 55 and 57? Well, then the 1040 rule could still very likely apply if you're going to be working with your PERS covered employer for more than 6 months. So again, usually school teachers fall into that calendar year, 6 months. That's why they call it the bubble. I worked 6 months in the August to December realm of that calendar year. And then I worked another 6 months the next year from January to June. That could work. But for most people, if you're going to be retiring and you have more than 30 years, you're tier two, so you're over age 60, then you don't have these hour limitations anymore, which is pretty great. Now, that is also kind of a bummer because you got to keep working, which most people call retirement. I call it, are you working in retirement or are we on a beach somewhere? Retirement. Those are two different words to me, right? So this word retirement can mean a lot of different things to a lot of people. Now, if you are wondering, what am I supposed to be doing? What action can I actually take? A lot of people assume, Daniel, everything you just said, it all just happens at retirement. There's nothing I can do. No, not even a chance. Absolutely not. That's not okay. We cannot walk away from this webinar thinking that there's no action items. So what do you need to do? Well, you need to review your union contract benefits if applicable, because that's going to tell me, hey, look, we got early incentive retirement agreements here. So you're going to get a lump sum buyout, or you might get a stream of income till you're 62 just to get out of here because they don't want to keep paying your high salary. That's pretty cool. They also might pay your healthcare for 5 or 7 years. They might give you a stipend for healthcare, or they might just give you a general stipend. So you got to know what your options are, because those union contract benefits are full of really, really awesome things that people have not read through. Some of these benefit, these MOUs and everything, you got a lot of different pieces of paper to read. I get it. Look at the table of contents, look for retirement benefits. It's usually like 15 or 16 articles in. Look at that. That's all you got to focus on for this point. You might be in a tier one or tier two, and you might actually be in money match. Okay. And if that be the case, you need to look to see if you have money in your variable account. This will show up on your PERS statement each year, and it will also show up on your PERS written estimate as well. The reason I say that is that I've had a client who was on money match. They wanted to retire in 2022. What happened in 22? The stock market didn't do so great. And variable accounts are invested in the stock market 100%. There are no bonds in the variable account. So you got to know, should I be doing a one-time variable account transfer while I'm still working? Most people don't know what that is. They didn't know that existed. They forgot that they even put money into the variable account, and they are suffering the consequences because their benefit dropped several $100s per month for the rest of their life because they didn't know this. And by the time we got there to see what they were working with, we said, okay, we got to do this as soon as possible, but there are 25-year working requirements, and we can only file at one time, and it's not going to be active until the next year. So there was just not enough time by the time they came to us for us to point this out and say, PERS does not do this overnight. There's a lot that goes into it. If you're doing PERS, IAP, voluntary contributions, look at stopping, because you can go online and stop those contributions. You can ask HR and payroll if you're not sure how to do that online. You can do this and say, hey, I realize now that I should probably doing Roth contributions into my retirement account so that I have total flexibility on my tax and investment side of this, not putting this into the IAP voluntary contributions as a non-deductible fund. The IAP fund changes can occur each year in September. So the whole month of September, you can go into your PERS website, just another reason to sign up with OMS and say, hey, I would like to change my target date fund. In the year 2022, people got to learn how risk really works, in my opinion, because bonds are supposedly less risky. Yet bond markets dropped about 15 to 20% in 2022 because interest rates went up and bond values went down. They always have an inverse relationship. What that meant was those of you close to retirement, the IAP fund that did the worst in 2022 was the retiree fund. That's supposed to be the safest one, yet not as safe as you think. So you might want to consider changing your IAP target date fund if applicable. You might be looking at all your assets and saying, well, I got rental properties. I got a S corporation with my spouse. I have, IRAs and 403Bs and so forth. Where does the IAP fit into this? The IAP might be your growth account. You might want to invest that in the most, quote, risky of the different assets categories that they have. It depends on your circumstance. That's why planning is so critical. So don't think that you just set it and forget it. A lot of my clients will find that number 5, hey, this is not the correct information. We just had one recently this year where we had to go through the archives with payroll, with PERS, and we were able to substantiate and say, you guys have not been reporting their years of service correctly. They got to retire a year earlier than they thought. I just love being able to help people do that because that is so critical for you to just be able to focus on what you love to do so that I can take care of it, make sure it's all being reported, right? So you might want to do what's called data verification or account reconciliation. Now, be very careful. Work with a professional with this process because if you do not know how to communicate with HR, they can simply say, this has all been the way it is, and now that is set in stone. So if you have a bad relationship with HR, I'm just saying, be cautious because if they don't do the digging to prove that you're correct, they can certify it and then you cannot change it from there. Okay. So make sure you know how to work with that team and go about this the proper way. Number 6, PERS purchase planning. There are 16 different purchase options. Some of them might be several $100s. You might have military leave. You might have military service, out-of-state service, forestry service. There's a whole host of it. So are you going to use your 457 to buy that? Because that could make a lot of sense. Okay, so now we know how to approach this versus you just saying, okay, now I'm retiring, but I need $75,000 so that I can make a purchase for something that's going to drastically increase my pension or maybe even allow me to retire several years before I ever thought I could because I can now increase my years of service by doing this purchase. So you got to look at that. Some of your purchases like wait time could be in the hundreds of dollars. Some of the purchases are going to be the tens of thousands. It just depends. Okay. Everyone's a little different. The tax remedy is something that came about in basically the early 90s. It used to be that the PERS pension was not taxed at all. And in the state of Oregon, I should say. And then now they said, hey, you have to be taxed in the state of Oregon, but we will give you a remedy. We're going to give you 9% to pay the Oregon tax, basically, if all your years of service were before 1995. For those of you who are on the track to retire, almost none of your service is before 1995. So that began to phase out. For my tier 1 folks, you usually get a few $100s maybe in your tax remedy, but it is not very much. That allows you to move out of state and you can say, hey, I want to move to California and pay even more in state taxes. Good on you. That's fine. Or you can move to Washington and pay no state taxes. Okay. I'm just telling you, those are our 2 border options, 2 extremes on each side of Oregon. So that's really critical for you to know, how does this impact me moving? If I'm going to go to Wyoming or Florida or Washington, one of these states with no taxes, that could be a huge benefit financially speaking, but you got to make sure it fits your lifestyle. The last thing I really like to make sure people hit home on before we talk about how to implement the retirement timeline is you got to know your PERS estate planning forms. If you're a tier 1 or tier 2 member, you actually have a pension beneficiary form because again, there's an account balance in there. Okay. A lot of people forget about this when they work with their attorney. Then you also have your IAP pre-retirement beneficiary form. And then you also have your special power of attorney document. So for example, let's say that you were working in the PERS, employer, and you started to show signs of dementia, you have a stroke, whatever it is, got hit by a car, you're unable to make decisions on your own going forward. If that be the case, please make sure that you have a special power of attorney document on file with PERS that says, hey, my spouse or this person is able to act on my behalf, to sign the PERS disability paperwork, to sign the PERS retirement paperwork, or my tax withholdings, or whatever else it may be. That person needs to be on file with PERS before you got to that place of incapacity. And certainly with the beneficiaries, that's critical as well. because you have a lot of tax rules now, non-designated beneficiaries and all this other stuff that came out of the Secure Act. That's really, really critical that you have that on file with PERS. Okay, last thing before we wrap up here for today. Really appreciate you. If you're still here, this is what we've been waiting for to put it all together. I wanted to give you an example of what's in my book, The Retirement Timeline. This is the first chapter because people don't know what to take away from this information. If all you took away was, okay, I calculated my PERS, it's $4,100 per month, and I can retire as soon as I get to 30 years at age 56. That's awesome. That is a fantastic starting point. You might also have a spouse, though, and they might be in the OPSERP pension, and they might want to retire with you at 56. They're wondering, why do I have to work another 9 years? So you got to make sure that you know, where does that fit? Because that one nugget of knowledge is only one out of about a dozen different things that are about to happen for your retirement plan. So if this example, I put this down as someone who was going to work the bubble or double dip. Okay. So at age 56, at this very first arrow, you can see they retired from PERS, started collecting $4,100 per month. They chose an option 15C. Okay. 15 years certain. And then they said, well, I'm going to work and get my full salary so I can max out contributions to my 403B and 457. So I'm going to actually officially retire, not just under PERS, but from my employer the next year when I turn age 57. The issue then becomes their district contract. In this example, this would be like a school teacher. We would say, well, hey, you are getting a stipend, not for healthcare though. So you're going to get some money, but now we got to fix this problem of your insurance. Well, it looks like your spouse is going to continue working another 3 years. So we're just going to put you on their health insurance. In the meantime, your salary just dropped by about in half, right? You went from $100,000 as the top tier school teacher to about $50,000 from the PERS pension. We're looking at your two incomes now and saying, wow, you just dropped from the 22% tax bracket to the 12% bracket. So what we're going to do is look at doing some Roth conversions to fill up that 12% bracket just during that 3-year mark. Why are we doing it just for the first 3 years? Well, that next spouse is going to retire at age 60, and now we've lost our health insurance. So to qualify for advanced premium tax credits, or APTC, we need to stop doing Roth conversions, don't we? Because Daniel's our tax guy. He told us that's going to really hurt us. Now we have the ability to say, hey, only one pension is coming in. The other spouse is not going to be taking their Social Security or their pension because they're on OPSERP. So we will be in a very, very low income bracket, making Roth distributions now that we're over age 59 and a half, and we will not show that as income. So we will get tax credits to pay for our health care. And then we will have the ability to then turn on Social Security. So this spouse on the bottom at age 62, we decide, hey, we need a little bit more income because we don't want to take too much out of the Roth accounts. Then we say at age 65, okay, now you're both on Medicare, so we don't have to worry so much about those tax credits, that 5-year period that we had. So we know that we've done all the Roth conversions that we needed to get through that point. But now we have our required minimum distributions coming at 73. So we got to plan ahead for that. So we're going to do conversions from age 65 to 73. Because that's going to be before we turn on the second Social Security check, which is going to be well over $3,000. So this is how you start to put all the puzzle pieces together. That's why I love showing you the retirement timeline. And I wanted to make sure that you know, how does this fit within my specific circumstance? Now, that was a lot of information. I got some questions and I'm going to take a second and answer here. You've been very patient, everybody, by waiting until the end. But I wanted to make sure that if you are just, your head spinning, and you're saying, I just don't know where I fit into all of this. I don't even know what I have. I don't know if I have a 457 or some of these acronyms, Daniel, that you presented. Give us a call. Go to ryanfinancialsolutions.com. Schedule a free 15-minute phone call with me or someone from my team. We'd be happy to walk you through as much as we possibly can. And if your situation warrants it, you got a lot of complexity. Maybe you have a rental property or several. Maybe you have a small business. Maybe you're wanting to set up a private foundation. Maybe your spouse has ISOs or RSUs or whatever their complexities are, and they're a highly paid executive, and they're wondering, well, is this guy really up for the challenge of corporate America, or does he just focus on public servants? No, I trust me. That's why I started with, I have all those degrees and designations. I'm just very passionate about helping public servants. It just so happens that most public servant families are also married to someone who's not a public servant. or their kids are not public servants and they need help navigating all of these different components. So that's why I love focusing on your household, your family. But we love helping you. Don't hesitate to reach out, info@ryanfinancialsolutions.com. Go to my website and you can certainly schedule a free time as well. So those of you who want to stay on, I'm going to answer a few of these questions that I've got here. And I'm looking at this very first one. This is a pretty popular question I get is PERS a lifetime benefit? Sometimes folks get confused when I talk about the refund annuity and 15C and some other of these tier 1, tier 2 options. The answer to the question is yes, it's a lifetime benefit. The monthly pension is. The IAP is not. That's a lump sum. You just get a dollar amount, or you say, hey, I'd like to take this over the next 10 years, 5 years, whatever it is. So that's how the difference works. But the PERS pension that they pay you per month, that is a lifetime benefit. So hopefully that answers your question. One of the questions I get is, okay, can I still work? Can I retire under PERS and still work? Absolutely. Yes, with the new Senate Bill 1049 that came out in 2020, that has allowed people to, with permission from their employer, continue to work. Now, a lot of people will think, hey, I got to really have a good relationship with my employer then, don't I? I say, well, that helps, but that's not necessarily the case. A lot of union contracts will spell this out. And so thus you didn't need approval per se, based on how much they like you. You can keep working an unlimited amount of hours now. So that has all been waived even through 2024. Originally, the Senate Bill 1049 was just for a 4-year period of time, but now they've waived that for the next decade. So until further notice, you can keep working in the public sector. I imagine that will stick around for perpetuity. And that's simply because there's less and less people who want to be permanently in the public sector. So they kind of need your help. Okay, that's the theory there. What if I have to resign? Will I get my full pension? Absolutely. That depends on whether it's right away or whether you need to wait, though. So whether you quit or resign or you were fired, whatever that might be, you always hear this with people who say they got fired with 29 years of service. They were so close with the federal pension or state pension or something like that. And that really isn't an issue. You being fired doesn't mean that you don't get your pension. Okay, that was a promise to you the whole time. So if you are in that normal retirement age, you can just say, well, this becomes retirement, right? If you're not and you're getting fired at 50, okay, and you're in general service, you can't just claim the pension if you don't have 30 years. So you got to wait until you hit that 30. Well, in this case, you wouldn't hit 30 years because you stopped working, but you would hit that normal retirement age of 58. So that's how that would work, but it's not an issue. You will still be fully capable of getting your pension. All right. Do you have to pay taxes on your Oregon PERS? Yes, everyone does. Doesn't matter if you are in the judge member program or police and fire or general service. Everyone has to pay state and federal taxes if you live in Oregon. What if you move to Washington? You do not have to pay Oregon taxes. You become exempt from that. So it all depends on where you domicile. Now, a lot of people will snowbird. So they will live in Oregon and they will fly to Florida or Arizona or something like that, Texas maybe. And that situation, it depends on where you domicile. That's a fancy word for where do you actually call home. So if you're filing an Oregon tax return as a resident, it's probably that you're going to pay taxes on all of your PERS pension. It doesn't matter if you spent 5 months in Florida where there's no income tax. That doesn't apply here. It will all be taxed in the state of Oregon at that point. Does the PERS pension give cost of living adjustments? Absolutely. And like I said, it's a blended COLA. So if you've been working since 2014, somewhere between 1.25 and 2%. So that being said, I think I've got all the questions. Can I leave the pension to my kid? That's the last question. And the answer is technically yes, but probably shouldn't is the answer to that one. So if you have someone that is considerably younger, like a child would be, typically several, maybe 2 decades younger than you, for example, that will make your pension smaller. So instead of getting $5,000 as an option 1, you might be getting $2,000 or $3,000 because you've put them as a beneficiary to your pension. That's only for option 2, 2A, 3, and 3A that will apply. That is based on the age of the survivor beneficiary, and you can only choose one person. So if you have 2 kids, you got to really play favorites. So that's why I say yes, technically, but probably shouldn't. Okay. Hey, this has been a lot of fun. I appreciate you guys sending all these questions. Again, if you have more questions, you want to just chat, find out a little bit more, that's totally fine. Go to ryanfinancialsolutions.com and we would be happy to help from there. Appreciate your guys' time. Have a great day.